All right, let's talk PropTech. For a while now, every headline has been screaming one thing, AI. But today, we're going to follow the real money. And trust me, where that cash is actually flowing might just change how you think about the future of real estate tech.
So let's just cut right to the chase. As we look ahead, where is the smart money in PropTech really, truly going? The answer? Well, it might not be what you expect.
And yeah, I'll give you a hint. It is definitely not where all the media hype and the constant buzz would have you believe. We're going to peel back a few layers on this one. Okay, first things first, let's just acknowledge the dominant story out there, the one that everyone is hearing and reading and talking about. And it all seems to revolve around one thing, artificial intelligence. It's being sold as the beginning, middle, and end of real estate innovation right now. I mean, you've seen this hype train, right? It's all about AI-powered property management, predictive analytics, generative design for buildings. It's a really cool, futuristic story. But is it the whole story?
Well, here's a little dose of reality from someone who's deep in the industry. Ashkan Zandia, a major voice in real estate tech, he just puts it out there bluntly. And that, right there, is our cue to start looking beyond the headlines.
So if the smartest folks with the money are getting a little tired of pure AI plays, where's the cash actually going? This is where we follow the money, because there is a really fundamental and honestly fascinating shift happening. And the one word you really need to get familiar with is adjacencies. Now, this basically refers to the essential nuts and bolts systems that are the literal foundation of a home. We're not talking about some flashy app here. We're talking about the bedrock, mortgages, insurance, power, water, and, the actual construction.
Let me just throw a number at you so you can see what this looks like in the real world. $156 million. That's a single huge funding round. But the real question is, who got it?
So that massive check didn't go to some hot new AI startup in Silicon Valley? Nope. It went to a company called Weaver, a debt services provider in India. You see? This is the shift in action. Big money backing core financial infrastructure. That's a classic adjacency.
And this isn't a one-off thing. Let's look at another one. This is Span. Started in 2018, it's now a full-blown unicorn with almost $400 million in funding. So what do? Smart electrical panels and EV chargers. Again, it's the physical, utility-based layer of a home that's attracting these massive investments. Now, to be super clear, this doesn't mean AI is dead. Not at all. Its role is just evolving. Like Zandieg says here, the days of just throwing money at AI for the sake of AI, well, those are over. Now AI has to be plugged into these essential systems to solve a real, tangible problem. It's a tool, not the finished product. So we've seen what's happening, but let's dig into the why. Why are investors suddenly pivoting from a cool story about disruption to the, let's be honest, less glamorous world of strong balance sheets? Well, the whole mindset in venture capital has done a complete 180 since the wild funding days of 2021. Back then, a good story might have been enough to get you a check. Today, investors want to see a strong balance sheet. The vague promise of disruption has been replaced by cold, hard proof of cash flow. And that growth at all costs idea, that's been replaced by a demand for financial discipline. And this really just nails it. After this whole period of speculative hype, the market is getting back to one of the most basic truths in business. Cash flow is king. And now the price tags on these companies, their valuations, are finally starting to reflect that reality again. So just how much tougher is it? Zandy gives us a pretty sobering, real-world example. If you're an AI company trying to get your first big round of funding, a Series A, and your whole business is built on tons of small contracts, you're going to have a really tough time. Investors want to see big, sticky, sustainable revenue. Okay, so we've got this new, disciplined investing trend. What could be the next big thing to pour gasoline on this fire? Well, the answer might not come from a tech lab. It might just come from Washington, D.C. Let's talk about policy. You're going to want to keep this name on your radar, the 21st Century Road to Housing Act. It's this big bipartisan bill that could seriously supercharge the very trends we've been talking about. The goals here are pretty simple. Cut through red tape, make it easier to get money for construction, and just generally get more housing built. It's already passed the Senate, which is a huge deal, but it is facing some headwinds in the House, so not a done deal just yet. So why does a bill in Congress matter so much to PropTech investors? It's simple, really. If this thing becomes law, it could kick off a huge wave of new development, and every single new house, every new apartment building is going to need the tech that supports its construction, its financing, and its utilities.
And this final thought from Ashkan Zandia just ties it all together perfectly. The second that policy makes it easier to build, who are the biggest winners going to be? The companies providing those essential, foundational services. They are all in the adjacencies.
So the big takeaway here is that the entire landscape of PropTech seems to be shifting from pure software to the hard assets that actually hold up our homes. Which leaves us with a pretty interesting question to chew on. Is the future of tech less about elegant code and more about concrete, copper wiring, and cold, hard cash flow? Something to think about. Thanks for tuning into this explainer.